Welcome to the Steadyhand 2020 Mid-Year Review. I'm Tom Bradley, and joining me today is Salman Ahmed, my partner and portfolio manager at Steadyhand. We have three sections to the presentation. First of all, I'm going to talk a little bit about what's going on out there, and many of us are asking those questions. Salman will take that context and talk about our strategies in the funds and how that impacts your portfolios. And then finally, I'm going to do a little musing and looking ahead. Before I do that, though, I want to give you an update on Steadyhand. And like every organization around the world, we've been working remotely. And I have to tell you, it has been really worked very well for us. I give our CEO, Neil Jensen, a ton of credit. He was ahead of the game on this. We were ready to go remote at any time. And so when the lockdown did hit, we moved very quickly and easily into that mode. And I must admit, talking to other executives who've had to turn their companies all on their head to try and adapt to the lockdown, we've been very lucky. And it's important that we were, because not only was our life getting thrown into turmoil and was all being working at home, but we needed to be there, and this is our client service team. We needed to be there because markets were obviously going through turmoil in March and April particularly. And I've got to say that our stats on answering the phone, on doing client reviews instead of in person, certainly on phone or video, and the amount of material we put out through those tough months, March and April, I think was very much on par with what we've done when we haven't been remote. I should also say that we've continued to grow, not quite as fast as we have been in the past, but we've been really blessed with some of you adding more money, taking an opportunity with these markets to add more money to your account, or refer us to friends and family who have signed on through this period. And we've had a very steady flow of new clients. So we're really privileged to have that situation. One of the things we've done is a number of virtual round tables, and David Toyne in our Toronto office has spearheaded some meetings with advice-only financial planners around the country to talk about a number of issues, but one of the issues we've honed in on is ESG. Salman's talked about a lot in other presentations: environment, social, governance. And this is something we're formulating a strategy around at Steadyhand. And so we've been looking for input from people. And so not only financial planners, we've done a couple of roundtables with clients who had expressed an interest in getting their opinion in the mix. And we will do some more, and we'll make it open to others who have something to say on these issues and want us to hear it. And so keep an eye out for that. So let's get on to the core of our presentation, which is, to start with, this question: why is the stock market so strong? The economy looks terrible. And indeed, we've had, I guess, what we describe as a V-shaped market recovery so far. And yet, that seems like a real disconnect, because certainly the economy isn't going to have a V-shaped recovery, and I don't think even the best case scenarios don't call for that. And I've got to tell you, the other day I saw some stats on corporate earnings in the US, and this was for the S&P 500 companies, and it showed the consensus of views out there showed that 2021, next year, would have higher earnings than 2019, and 2022 would even be higher than that. And that number really, I thought, was remarkable in the sense that given the kind of recovery we're likely to have. And so when things don't make sense, what do? Well, you get on your analytical hat and dig in and try and figure out why that's the case. And that's certainly what we've done here. And I think when you do that, you'll see that there's some good reasons why the stock market is up as much as it is in recovery. One of the first reasons is that it's being measured, this recovery, from a very, very low base. The March lows were very extreme. Indeed, the panic in the market was something like I've never seen in my 37 years of doing this. And so it really makes the recovery look more dramatic when it's being measured from some panic-induced, very temporary lows in the market. One of the other factors I think that sort of is misleading in this market time is that the market has been very narrow. And what we mean by that is that it has been carried along, and this is actually not the broad market, this is the NASDAQ Composite Index, which is very tech heavy, technology heavy, and you can see it's been, it went down, but the big five tech stocks and others have led the market back up such that the NASDAQ is up close to 20% on the year. And meanwhile, a vast majority of companies out there are well below their highs of February, many of them significantly below, as they sort of languish under the uncertainty of the recovery and how their industries will come out of it. But the final reason that as I assess this market recovery, which I don't think has been talked about enough, we talk about the economy and what it's going to look like, but is the impact of interest rates. This is a chart of the Government of Canada 10-year bond yield. It actually goes back to the beginning of 2019. You can see through a good period of this, a good amount of this time, it's bounced around 1.5%, very low. I describe that as recessionary levels of interest rates. But here we are a full point below that at 0.5% now in response to the COVID crisis. And I suppose we could call it depressionary interest rates today. But low interest rates, when they're this low, is one thing, but the other thing is the market, I think, and investors in general have decided that they're going to stay low, stay near zero for an extended period of time. And that has a dramatic impact on stocks for two reasons. One is it takes fixed income out of the game. Going to the bank to get a savings product or buying a bond like the one I'm showing you here, doesn't do you much, and you lose ground to inflation. So what happens? A lot of the money that was designated for fixed income migrates up the risk curve into stocks. The other thing it does is that it makes companies more valuable. The value of a company is derived from its stream of earnings and cash earnings and dividends over long periods of time. And so those future earnings that are out there 10 or even 20 years from now have to be sort of discounted back to the present day so we can put a value on them. When you discount them back at a lower interest rate, it can have a dramatic effect on the value of the company. So interest rates, well, it's not getting much of a fuss in the context of all the economic issues other economic issues we have, has had a huge impact on how companies are valued. So as we go through this remarkable time with the coronavirus, one of the things that I've said to people is what the markets have done through this is what they always do. Markets are unpredictable. They overreact to things, and they very much look forward. They're not reading what we're reading in the paper today or even next week. They're looking a year, maybe even 2 years out. And clearly the market's saying, we'll get through this, and maybe it won't be perfect in 2 years, but we will get corporations will be making money and justifying their valuations. So with that, I'm going to leave it, turn it over to Salman to take over and talk about our strategies.
Thanks, Tom. In this environment that Tom has just talked about, our funds as a whole have been the most active they've been since 2008 and 2009. And we can take the Founders Fund to expand on that. In early March this year, before the market mayhem really struck, we were reducing our weight in stocks. In the Founders Fund, we were holding about 56%, which is less than our long-term target of 60. This, of course, turned out to be quite fortunate because it gave us that extra cash we needed to deploy during the market correction. Specifically, we were adding most on those days the market fell steepest. Those purchases and then the subsequent rebound that we've had pushed our weight in stocks above our target then. And since then, once again, we've been trimming stocks back to get closer to 60%. Now, these shifts have served our clients well, but they were triggered by what was going on in our underlying funds. As a reminder, the Founders Fund gets to its target allocation by investing across our lineup. And it's the managers on the right side of your screen there, the ones in the dark blue, are stock-focused funds. The managers of these were the most excited we've seen them in a very long time. In just the first 6 months of this year, they've changed almost 20% of the names in the portfolios. And they've done a lot of trimming and adding to existing positions too. And now for context, this is more than double our usual activity. The manager of our equity fund, Gord O'Reilly, he's quite measured and rarely shows emotion. But in late March, when we were speaking to him, he told us that these were the best opportunities he'd seen in 10 years. But our managers, those stock-focused managers, equity-focused managers, the four of them, have taken somewhat different strategies in what they own. Our equity fund and our global small cap fund, well, they own faster growing companies that might cost a little bit more as well. For example, our global small cap fund owns Zynga, which produces popular mobile games. You might have played them. Words with Friends is one that Zynga produces. In the period of quarantining and social distancing, a lot more people are playing these mobile games now. So Zynga has done very well. By contrast, our small cap and global equity fund, they've bought names that are more sensitive to the economy, companies that can definitely survive over the next 18 to 24 months with little or no revenue, but really benefit once the economy does get back up on its feet. Our global equity fund, as an example, bought Safran, which makes airplane engines. Now, at first blush, you might think, "Oh my gosh, why would anyone buy that? No one's going to fly these days." And definitely, our managers don't expect long distance travel to return to 2019 levels for many years, but there is still demand for shorter range flights, specifically in developing economies. And a lot of that demand comes from shorter range or short haul flights. China has already seen its domestic flight capacity return to 70% of pre-COVID levels, and Safran is one of just two companies that builds and maintains engines for these types of aircrafts. But as you've heard from Tom, it's those faster growing companies like Zynga that have done best over the last 6 months. And the equity and global small cap equity funds have benefited most. They've held up better than their respective benchmarks. They've kept us in the game, really, along with our income fund, which owns bonds, which we expect to hold up well in periods of tumult. But it's those funds that haven't done as well, our global equity and small cap equity fund, that have us most excited. It's because they both own businesses that have the necessary traits for strong future returns. These companies have good balance sheets, cash earning power, a track record of success, but perhaps most important, they're starting at a low point. There's just fewer expectations about these companies. Tom, you've moved my slide. Yeah. Um, so other investors have very low expectations of these companies, which gives them a good starting point. There's just a lower hurdle for them, and definitely there might be a case if we have a second wave where these types of businesses, their stocks don't do as well. But as investors, we have to look beyond just 2 or 3 years, and when we do that, we believe it's the companies that have high quality franchises that people are pricing as if though they aren't going to survive that are going to perform best. I'll now pass it back to Tom, who's going to talk about how we're putting all this together and what we're suggesting clients do through this period.
Thanks, Salman. going backwards here. I had a friend tell me the other day that it felt like she was living in dog years, and I could relate to that. 4 months has felt like, I don't know, 3 or 4 years. And, we really as a society have been slammed hard. And it's very easy to be very pessimistic about not only what's happening now, but in the future. Some things are not going to ever be the same again, but we don't know exactly what those things are. And I do think we need to take a balanced approach, not only in how we live our lives, but also how we invest. So let me give you a few thoughts as to how we're thinking about the future. And the first one is maybe a little bit of an optimistic one, but I'm a big believer that people are amazingly flexible and adaptable. And I think the last 4 months has proven that. And human organizations are also very adaptable. And so I think we'll be surprised at how companies, specifically relating to our portfolio, adapt and move on and take advantage of clearly a very severe crisis. But there's no doubt the recovery is going to be uneven. There's going to be full of surprises, and there's going to be some industries like the one on the left here that are going to be frustratingly slow in recovering. Think, cruise ship bookings for sure, travel to see the Eiffel Tower, all those kind of things will be slower, there's no doubt. But there's going to be some parts of the economy that we're booming. I'm just back from a few weeks in cottage country in Ontario, and I can tell you, trying to find a paddleboard or a paddle, there is good luck with that. They're all sold out, and from what I understand, RV purchases and rentals are sold out for the year. So money is being allocated to other parts of the economy, and so there'll be some surprises as we go through these different times. I think one of the things, though, we have to watch for as we go forward is that I put it this way, I find that commentators and investors today have very much said that the winners from the lockdown period, and you can see the list there, some of these they're great companies and they've done really well. There's been a declaration that they are also going to be the winners in the new normal, the period as we open up the economy over the next months and years. And I think that's a bit of a heroic assumption. Some of them will benefit. I mean, probably they're all great companies, but with their performance has come much higher expectations, and it comes in the form of higher valuations. So when a company's trading at 35 or 40 times as opposed to 20 times earnings, the markets expect them to deliver and keep growing very, very rapidly and not ever making a misstep. And so as Salman has talked about quite extensively here, we do think that in the new normal, the future winners, there'll be some of the ones from the past, but there's going to be a lot of different winners, and so we want to diversify our portfolio across a wide range of companies. One of the reasons we're optimistic about those two funds that Salman pointed out, the global fund, which has clearly been a tough fund for us, and the small cap equity, is that the valuations on those companies where there's a bit of a cloud over them is very good. They're on sale. And most of these companies, or virtually all of them, are leaders in what they do. They're well financed. Our analysts have gone up and down them to make sure they can survive this slowdown. And they are selling goods and services that will be required in the new normal. So as we talk about our strategy and what we're doing in the funds, I'll just spend a minute at the close here to say what you should be thinking about. And certainly, we don't think any investor should get locked into one view of the world. That's very much a risk at extreme times like this. We get very emotional and we get leaning one way or another. But the range of possible outcomes in the market is very, very broad, maybe as wide and uncertain as I've ever seen in my years. And so We still think it's very much makes sense to be diversified and have some irons in the fire in the past winners, but also the potential future winners, and not go down one path or another. Go all tech, go all banks, go all into cash because you're uncertain. And indeed, where we think uncertain investors should go is to their plan. We talk a lot about SAM, the strategic asset mix, which is embedded in a financial plan. And that is super important. That is where you want to go to hide. And so, as we've said to you before, we named the company very intentionally, Steadyhand. And please feel free to come if you feel uncertain or you don't know whether your plan is right. We want to hear from you. So thanks for coming, for listening today and watching, and we look forward to coming back to you soon.